I hear a lot of people say we're at the top. I'm going to buy when real estate crashes. I'm going to buy big when real estate crashes. But we can't time that. Hey everyone, Travis Spirit, Pine Financial Group, where we work together so you succeed. Thanks for checking us out on YouTube today. Make sure you hit that subscribe button so you see every time Pine Financial Group brings out great new content. Today, I'm going to talk to you about dollar cost averaging. Does it work with investing in real estate? If you're familiar with dollar cost averaging, or even if you're not, let's talk about it for a minute. So the idea of dollar cost averaging when it comes to investing would be something like you might do with a 401k account or an IRA account in a traditional sense. So every month you're going to save a portion of your paycheck or your income, maybe a percentage of your income or a flat dollar amount, and you're going to put that into a fund. Example might be like a mutual fund or an index fund, or if you're invested into a 401k with like a Schwab or something like that, it's going to go into that account. And what it's going to do is it's going to buy shares or a piece of a mutual fund or index fund as an example. So let's say you're saving $500 a month. That's going to buy as many shares as $500 will buy. And the idea of the dollar cost averaging is that, some months those shares might be $10 each. Some months or years, they might be $15 or $20 each, but you're going to continue to put in the same 500 as your investment and it'll buy however many shares that 500 will cover. So the reason that investing model has become popular is because it's consistent. And so over time, you're going to put the same amount in there, regardless of what the market's doing. If the market's down, you put your money in. If the market's up, you put your money in. And if it's flat, you put your money in. And so over the period of time, let's say over 30 or 40 years of working, and you're putting that money into your 401k account, it's going to grow over time. And you're going to ride the market. One of the biggest benefits identified by doing dollar cost averaging is that you're not going to time the market. If you had the ability to time the market, you probably wouldn't be watching this video. So same could be true in real estate. In the stock market, it goes up and down over time. And the general idea is that over a period of time, it's going to increase in value and you're going to have the principal amount you invested plus the amount that the investment has grown over time, getting you to the amount of dollars that you need to hit your retirement goal. The same could be true in real estate. Although it's not technically dollar cost averaging because we're not taking $500 a month and investing it into a specific property and our shares in that property are growing, the real thought here is more or less not trying to time the market. So we invest in our retirement accounts, whether the market's up or whether the market's down, because that's what we were taught to do. You just continue to put your money in there, and where the market is as far as evaluation really doesn't matter until you get to the age where you can actually touch the money. Now, unfortunately, we live in a space right now where you could pick up your iPhone at any point in time and see what the market's doing that day. And even if they're retirement dollars you can't touch for 10, 20, 30 years, you still kind of feel that pain as you watch those dollars go away. In real estate, dollar cost averaging would be similar because you're going to use the money that you're saving or earning to buy another property when the time fits for you. So as an example, let's say that you make enough money to buy a property with 25% down every year. So more or less, you are saving that money in an account. And when you hit your 25% down, you're going to buy that property, collect the cash flow, wash, rinse, and repeat, and continue to do that. So you're going to buy properties on a systematic approach, regardless of what the market's doing. We can't time the real estate market either. I mean, as we sit here in 2020, the market's been on a pretty strong pull for about 12 years. And I hear a lot of people say, we're at the top. I'm going to buy when real estate crashes. I'm going to buy big when real estate crashes. But we can't time that. So you have to consider what your opportunity cost might be. So let's say you buy a property today at the top of the market, but next year could be even higher. And then next year could be even higher than that. So it's difficult to identify when the top of the market's going to be. But just like your investment accounts or your 401k, if you're a long-term investor, what the values do in the short term really don't matter unless you're going for a refinance or selling the property. Otherwise, you're just going to ride it out until the time's right where you might sell that property or just continue to collect the cash flow to retirement. As long as an investor has plenty of reserves to go through a downturn or even a time like when COVID-19 put the halt on evictions and you may not have been able to collect rent or evict somebody for 6 months, those are the things we have to plan for. But if you consider the eviction moratorium that the government put in place, the market was red hot, but we can't evict. So challenges in real estate investing can come from a number of different ways. So going back to dollar cost averaging in real estate rental purchases, let's say you bought your first property 10 years ago for $100,000 and a couple of years later you bought one for $125,000 and a couple of years later you bought one for $175,000 and so on. So you're continuing to build your portfolio, but it's taking more money to do that. Now, the rents that come out of the properties are going to be pretty much the same, right? If you're buying in the same neighborhood, the house that you bought for 100,000, you're going to collect the same amount of rent on the house you bought for 175 in the same neighborhood. So the net income from each property is going to be a little bit different. But the idea would be when you're on the, let's say a 30-year note, because I think that's what most real estate investors are using, 10 years from now, you're going to be paid down X amount, 15 years, and then 30 years of property is going to be free and clear. The real way you make money in real estate is with free and clear properties. You'll get a little bit of cash flow along the way, might be enough to cover your expenses or cover some turnovers. Your wealth is going to grow through the value of the property increasing, but the cash flow is really just gravy. But that's how you're going to get to retirement and have the dollars to spend in retirement. So when I approach rental real estate with the idea of dollar cost averaging, I'm not actually talking about buying a little piece of the same property over and over every month until I own the property. It's more of the idea of not trying to time the market. We invest in real estate when the market's up. We invest when it's down because we don't have the ability to time that. Now, when the market comes down, and there will be a time when that happens, let's be well capitalized and have the right relationships to continue to buy property. So it's interesting when I hear people talk about, I'm going to buy when the market drops or when the bubble bursts. A lot of people may not know, but when the bubble burst last time, it was really difficult to finance property. So now that the prices are great and the cash flows were awesome, it's really difficult to get a loan on that property. So you got to consider today, relatively easy, really low rates, maybe the highest prices, or later when it becomes much more difficult to finance those same properties. Here's another thing to consider when we talk about being at the top of the market. If you look at the median price of homes in the United States over roughly the last 70 years, you'll find that in almost every year, the prices were higher than the year before, except for about 12 of those 70 years. A couple of blips in the 80s, 90s, '01, and then, of course, the Great Recession. So if you think we're at the top of the market now, we certainly could be. But the good news is when real estate prices fall off, rents don't typically fall off as fast, and you should be okay as a long-term investor. I'd love to hear your feedback on how you approach buying rental real estate over a period of time, and if you consider it to be dollar cost averaging. Thanks for checking us out today on our channel. Be sure to give us a call for any of your financing needs. Phone number is 303-835-4445, pinefinancialgroup.com.